In this video, we're just going to be starting to look at how the budget can be used to achieve external stability. Before we do that though, I just want to have a quick chat about the impact lower oil prices are having on the budget. There are a couple of impacts that the lower oil prices are having on the budget. First of all, lower oil prices are helping to reduce firms' costs of production. So transport costs are lower, it's reducing firms' costs of production, and that's basically allowing them to increase their profit margins. Because it's costing them less to produce, they're increasing their profits, and that's increasing the level of company tax. And it's important that you make that link, but regardless of what thing you're talking about at that point of time. If it's helping to increase businesses' profits, whether that be strong overseas growth or a high Australian dollar or anything like that, you can link it to company tax. The other good thing is that the lower oil prices have increased consumers' discretionary income, so it's helped them to spend more money in other areas of the economy, and that's been good for employment and profits within other industries as well, also increasing the level of company and income tax. From a bad perspective, the only thing that is bad about the budget is that oil-producing companies are making less money. So any company that's known for making oil within Australia is experiencing a fall in their profits and therefore paying less company tax. Also, it's also hurting LPG industries or gas industries that are substitutes for petrol, because the lower price of oil and petrol has reduced demand for LPG or gas. So that's the other weaknesses of lower oil prices for the budget. Also, shareholders are making less money if you've invested in any of those oil-producing companies. So, the budget and external stability. First of all, external stability is not one of the primary goals of the budget, but in order to improve external stability, it's about trying to reduce the budget deficit, so we reduce public sector debt. It's also about trying to improve our level of export sales as well. So a couple of things to remember is that this year's budget will not reduce the government's level of net foreign debt because we're still in deficit. The debt is likely to increase. Secondly, that public debt is only part of the total level of net foreign debt. There's also a private component. And the government doesn't have to borrow from overseas to fund their deficits. They can borrow from local companies as well. So public sector debt can include money that the government owes to the private sector as well. The impact of the 2016-2017 budget on external stability. When discussing the impact of this year's budget on external stability, first of all, you want to be linking it to the main components of external stability, so the CAD-GDP ratio, achieving a sustainable level of net foreign debt. When you're referring to this year's budget, you would say that the reduced deficit this year is helping to slow down the growth in public sector debt. So public sector net foreign debt is still increasing because the government's still spending more than they're earning, but the lower deficit should help to reduce the growth in public sector debt. This may help in the long term preserve our credit rating and keep interest payments down, but many people argue that this year's budget is really a more relaxed approach to fiscal consolidation. So it's not really, even though the deficit is smaller, it's only marginal, and this is so we're likely to be in deficits for years to come, and that's going to put more and more pressure on public sector debt. All right, external stability, not a very important goal, not one of the key ones, but still relevant. It's all about achieving external instability means when the current account deficit is unsustainable and net foreign debt caused by national spending is too high that it exceeds national income. This leads to decreased credit ratings, increased cost of debt, and makes it harder for us to expand our economy in the long term. So budget surpluses can have an expansionary impact on the long term because they help to keep our credit rating higher, give us access to infrastructure, gives us access to money to spend on infrastructure, and also helps to give us a pool of savings for any future investment. So basically, when we're linking budgetary policy to external stability, there's two things that we're going to link it to. One, about the government increasing national savings, and two, about trying to increase our share of world income, which is basically a fancy way of saying that we export more to increase our share of world income. But increasing national savings is about trying to reduce public sector debt. So it's generally associated with contractionary policies that will help to reduce the gap between investment and savings. If that might be tax concessions for savings, it might be higher tax rates, anything that's going to slow down the level of imports and slow down the level of spending will help in the short term. So this is one of the key things to this chapter. Why does a budget deficit generally lead to a higher current account deficit? So if the budget's in deficit, the government's spending more than they're earning, why does this generally lead to a bigger current account deficit. And there's two reasons for that. One, a bigger budget deficit is generally expansionary and is generally a sign that we're likely to be importing more. So a bigger budget deficit leads to increased import spending, which increases the deficit in the balance of merchandise trade section of the current account. So, for example, if we have lower taxes or increased welfare, that will boost import spending. Secondly, higher deficits also lead to more public sector debt, which increases the government section of net foreign debt and therefore increases interest repayments. So on the flip side, a lower budget deficit should help to reduce the CAD for two reasons. One, it's generally associated with contractionary budgetary policies, which will reduce import spending and therefore reduce the amount of imports and amount of debits in the balance of goods and services section of the current account. So contractionary policies reduce spending in Australia. It's like the cyclical component of the CAD. And secondly, higher national savings or budget surpluses often reduce pressure on public sector debt. So the government, higher national savings reduce pressure on public sector debt is basically meaning that if the government can run surpluses or reduce their deficits, they should be able to reduce their section of debt and therefore reduce the amount of income they have to pay on their debt. So more contractionary policies reduce interest in the net primary income account and reduce the amount of debits in the balance of merchandise trade and net services account because we have more disposable income, less disposable income. Surpluses help to reduce interest on public debt, and contractionary policies help to reduce spending because of higher taxes. We'll talk about the problems of this theory in the next video.